Many of the funds that I invest in, so my split funds, closed-end funds, as well as the covered call ETFs that I always talk about on this channel, they classify a portion of the income that they give out as return of capital, or ROC. So some of them give a small portion in ROC, some of them a higher portion, some even classify all the income for the year as ROC, so 100% return of capital. But if you look up what ROC income means online, you will probably start scratching your head. So here's the definition according to Investopedia. Return of capital occurs when an investor receives a portion of their original investment that is not considered income or capital gains from the investment. Note that a return of capital reduces an investor's adjusted cost basis. Once the stock's adjusted cost base has been reduced to zero, any subsequent return or return of capital will be taxable as a capital gain. Whoa, hold on a second. This is pretty much saying that this income is just your original investment coming back to you. That sounds kind of like a scam or a Ponzi scheme even, right? ROC income has to be bad, right? Unfortunately, many investors still believe that that's the case. So although this definition is technically correct, there is much more to it than meets the eye. Also, if ROC income lowers your ACB, or your adjusted cost base, which is basically a fancy way of saying book price, how do you track all of this? So just like my new and remastered Split Funds Explained video that was released recently, I decided to make a remastered video on return of capital. So let's explore ROC income together, guys. I'll show you why ROC income is not necessarily bad. On the contrary, I learned to love it, and hopefully by the end of this video, so will you. So just in case you didn't watch any of my tax videos and my first return of capital video, I'll quickly show you a few funds where you could clearly see what portion of their income is classified as ROC. It's very easy to look up. Anybody could do it. So let me show you real quick just a few examples. First example we'll look at is ZWC, a very popular covered call ETF here in Canada. So if you click on tax and distributions and scroll down, if you select we'll select 2020 because the information is not out yet for 2021. If you go all the way at the bottom here, you could actually see what portion of the income is classified as what. So the total dividends received for 2020, or the total income provided from this ETF, was $1.32 a share. And you could see the actual breakdown. So 66 cents, or a little more than 66 cents of the $1.32 is classified as return of capital, or ROC income. And the rest is classified as eligible dividends. Another example, another covered call ETF that I love, TXF, that deals with the technology companies. You could actually see, if you click on distributions, so for 2020, obviously 2021, the values are not out yet. But in 2020, you could see that the total distributions per share, or the total income, was $2.15. And you could see that 67 cents was capital gains, $1.43, so the majority was return of capital, and just a tiny bit was foreign income. And it's not just ETFs and funds, guys, it's also REITs. So let's go through a quick REIT example here. Firm Capital. So stock symbol FCD.UN here. So this is a very, it's one of the 4 REITs that I still own. So if you go down and you click on tax information and you go to 2020 distribution tax allocations, you will actually see the classification of each dividend. So you see the total cash distribution per unit, so the monthly dividend, and which portion is classified as a ROC, so return of capital. So for this REIT, 100% of the dividends are actually ROC income. You could see that here, right? So that's just a few examples. So now that you know how to find the actual ROC income, or the classification for any given fund, whether it's a REIT or an ETF, it's time to discuss why managers actually give out ROC income. Are they simply giving us our money back? I would say not necessarily, and furthermore, it's probably not the case. Why do I say this? How can I prove this? Well, let's check out 3 articles that explain ROC in detail, because there are really 2 types of ROC out there: good ROC and bad ROC. So these 3 articles are really what helped me understand ROC income and how it could be generated and why it's generated. So let's check them out together. All right, guys, so the first article I want to cover is an article I covered in my original ROC video. So I'll show it to you again. It's actually from Harvest. It's on the Harvest website. And don't worry, I'll put all links to the 3 articles in the video description so you could check it out yourself. So in this article, there's a question here. Can you explain how your tax factors for distributions have been treated as ROC, return of capital, and are you just giving me my money back, or that's referred to by these guys as grinding the net asset value? So here they go on to say that from a tax perspective, the covered call option premium, so the cash flow received from writing the covered calls, right? The money they generate writing those covered calls is actually considered capital gains income. So let's consider 3 scenarios. So an ETF with a NAV of $10, so a value of $10, and during the year generates $1 in option premium. Keep in mind that this is always, $10, $1 per share. So this $1 is paid over the course of the year as a distribution, and the investor would receive the $1 of cash flow during the year, and on the tax receipt, it would be treated as capital gain, of course, because that's from covered call premium. So the NAV would still be $10, right? Because it starts at 10, it made $1, it gives you $1, so the value is at $10. But what if an ETF has a NAV of 10, this is the second scenario, and no option premiums were generated, but they still give you $1 in distributions? Well, we would receive the $1 of cash flow during the year, and on the tax receipt or on our T3 statement, it would be return of capital, and the NAV or the net asset value would be $9, right? It makes sense because it's $10, they made no money or no income whatsoever, no covered calls, and they still gave out $1, so the value would be $9. So this is the bad ROC. Encroachment of capital is what they call it here, or grinding. So here they go on to say, and this is the interesting part here, there are several situations where an unrealized loss, key word here, unrealized loss, becomes a realized loss in an ETF, like when a stock is sold at a loss. So while there's no real impact on the NAV of the ETF, there may be the ability to carry forward the tax loss. Keep in mind, guys, that capital losses can be carried forward indefinitely from year to year to year. So what they're saying is that this capital loss can be utilized against the option premium earned, and that can change the tax treatment despite the cash flow being generated to pay the distribution. So they give the example of this good ROC here. So let's say an ETF with a NAV of $10, sticking with the same numbers, they do generate $1 in option premium, and they pay the $1 in distributions during the tax year. So if the ETF had a loss carry forward or has realized losses during the year, then for tax purposes, that could be applied to the $1 capital gain, of course, because capital losses can offset capital gains, and option premiums or covered call income is considered capital gain. So that $1 that they did generate would be treated as return of capital. So the amount of the return of capital reduces the adjusted cost base of the units held. That's just the definition of ROC. So when the investor chooses to sell their holding, they would have to pay a $1 capital gain. That's, of course, if they choose to sell it, right? However, the investor has deferred that proportion of the capital gain into the future and when they sell it. So basically what they're saying is that if the ETF has a NAV of $10, they do generate $1 in income coming from the covered calls, but they had a loss in the previous years or in that year. What they could do is take that loss and offset that $1, and instead of giving it to us as capital gains, they give it to us as ROC income. So this is basically the first scenario, so which is good ROC income, which means they could simply take previous losses and offset capital gains and turn it into ROC income. So in this case, ROC income is not bad at all, guys. The second article I want to show you is it's actually a pretty old one, but it's a really good one. So in here, he talks about what ROC is, and here's a good part here: good ROC, and then he goes into bad ROC. So good ROC, there's 2 sources of good ROC. The first one is the distribution of amounts that are non-taxable due to various tax deductions. So I didn't know this. I learned this recently by looking at this article, such as depreciation, amortization, whatever that is, of financing fees. So this all has to do, it sounds like real estate, right? And they go on to say that, yes, this is why REITs can some of the income, they could classify it as ROC income. So because they could deduct expenses like mortgage interest, maintenance fees, insurance, property taxes. So the actual rental income, what he's saying here is it becomes ROC income. That's why that example I showed you before of that REIT, how can it be 100% return of capital? Are you telling me they haven't collected any rents all year and they're just giving me back my money? No, it's because they could finagle around all these stuff here and turn the rental income into ROC income. So that explains it for REITs. But then there's a second type of good ROC, which actually is one that I didn't really think of until I read this article. And this is actually a bit more important. So the second type of good ROC income here is when a fund, listen to this, distributes its unrealized, keyword, unrealized capital gains to investors at the end of the year. I'm like, when I read this, I'm like, how can they distribute unrealized capital gains without selling them, right? Because to actually realize the gains, you gotta realize them, which would turn it into capital gains. So how do they do that? Well, here they go and give an example of that, where let's take the example. So let's say a fund has a value of $1,000. During the year, the fund nets, after expenses and fees, $30 in dividends. So $20 in realized capital gains, and then pays out $100 of cash at the end of the year. So at first glance, it looks like bad ROC because the fund only earned $50, right? $30 in dividends, $20 in capital gains, but it paid out $100, right? Yet it's distributing $100, which seems to represent the return of your own capital. But what if, here's the key, what if the fund's net asset value at the end of the year increased to $1,100? So from $1,000 to $1,100. Then the balance of the $100 being distributed, other than the $50 that they actually made, right? $30 dividends, $20 capital gains. So $50 is non-taxable ROC, which essentially represents the unrealized gains in the fund that particular year. So again, this amount reduces the investor's ACB. So this might kind of look confusing at first glance. And it was to me until I found the third article, which has a picture in here that basically explains it all. So you have the total return of the fund year. So you have the net investment income. This is just an example. The realized capital gains, so any capital gains or covered call income. And then you have the unrealized capital appreciation or the unrealized capital gains of a fund, as well as the shareholders' initial investment here. So if you scroll down, they go on to say that return of capital is a choice. It's a choice that the fund managers could give us. So if you scroll down, and you could actually see it here. So the net investment income, so the dividends, the covered call options, that would fall under here. Realized capital gains as well. So if they buy low, sell high, and of course covered call income as well would fall under realized capital gains. This has to be distributed to us, the shareholder, right, in income. But then there's also the unrealized capital gain or capital appreciation, and then there's the shareholder's initial investment. So just like the second article said, if there is unrealized capital appreciation in the fund and they want to distribute it to us as income, they want to give us the unrealized capital gains without realizing them, well, all they have to do is take it from this portion here, and which will make it ROC income. So getting ROC income, guys, is not bad because it literally could be unrealized capital gains that they're giving us tax-free by taking it from this block. Whether they're taking it from this block or this block, it makes no difference to the value of the fund, right? That's what the second article was talking about. It makes no difference. So I would much rather get it from here. This is why the fund managers take it from here instead of here, because here they don't have to realize it, and they don't have to sell to make the capital gains, so they could keep it within the fund. And if they take it from here, they could give it to us tax-free with ROC income. If they would take it from here, they would realize the capital gains and it would go in this box. So they would have no choice and we would have to pay capital gains tax. But instead, they get it from here. So hopefully this was clear, guys. So there you have it, guys. As you can see, there's much more to it than meets the eye when it comes to ROC income. So I will put the links to the 3 articles in the video description below. Of course, I strongly suggest you check them out. So the way I see it, guys, is that fund managers or even REITs have the ability to classify a portion of their income that they give out as ROC income to benefit us, the shareholders, so we pay less taxes. They're actually doing us a favor. So think of ROC income, guys, simply as a tax classification on the income we receive and not necessarily our money coming back to us. So although that's technically the correct definition, ROC income can simply be unrealized, like we just saw, unrealized capital gains that the fund manager wants to give us without actually realizing those gains, aka selling the shares at a higher price. So if they would do that, they would trigger the capital gains. The income would be classified as capital gains, not ROC, and we would have to pay tax on it if we hold it in a non-registered account, in our cash account, right? So if a fund is valued at $10, guys, and makes $1 in capital gain, and they want to give us that dollar in capital gain as income, well, in the most tax efficient way possible, what they'll do is they'll just take $1 from our original investment and give it back to us instead of, so they could keep that $1 of unrealized capital gain inside the fund. It makes no difference to the value of the fund whatsoever where they take that dollar from. So the fund will still be worth $10 after they pay that $1, right? So wouldn't you rather not pay tax on it? This is shown beautifully in that 3rd article in the picture like I saw. So ROC income also can be losses carried forward to offset capital gains as well. We saw that in the 1st article. And then REIT managers also have the ability to classify some of their income as ROC as well, like we saw in the 2nd article, depreciation and interest and maintenance and all that. So in summary, guys, most people think, well, actually, before I get to the summary, most people think that REIT income is taxed the worst because they think it's rental income, so it's taxed like regular income. So it's simply not the case. So if you hold any single REITs, go ahead and check the tax info on them on their official websites. It's really not hard to find. I showed you an example. Most, if not all of them, including RioCan and even the big ones, will have a portion of their distributions as ROC income. So to summarize, in my opinion, guys, I don't think ROC is anything bad. I think of it simply as a tax classification, the best tax classification, by the way, because it's tax-free. Of course, if we're talking about the TFSA, the RRSP, none of this really matters in the end, but in the cash account and the non-registered, it does, because we want to pay the least amount of taxes possible on our investment income, right? This is why I always tell you guys that the funds I invest in are very, very tax efficient. This is why my wife and I pay no tax on our investment income in our cash accounts. I get questions about this all the time. How much tax do you pay? You must pay a lot of tax. Well, because a lot of it is ROC income, there's no tax on that portion. The other portion besides ROC can be eligible dividends, which, by the way, if you're not working, you have no salary income, you have a big portion of eligible dividends that's not taxed at all. This amount, of course, varies province to province. I think Ontario is the best, and I think Quebec is the worst, but it's about 50,000 or something in Ontario and 36,000 in Quebec or something like that. So that's eligible dividends. And then the rest is pretty much capital gains, which is taxed really well in Canada. It's taxed according to your marginal tax rate, right? Which is very low if you have no salary income like us. On top of this, we still contribute to our RRSPs because we have a lot of leftover space from our working days, right? So RRSP contributions, guys, helps to offset all income, including the capital gains income. So in the end, not only do we not pay any tax, but for 2020, we actually got tax refunds. Okay, so now it's time to talk about the ACB, the adjusted cost base. If you're getting ROC income, how do you track what your book cost is, what your adjusted cost base is? So yes, by now you should probably love ROC income, hopefully, but ROC income does lower your book cost. So what the heck does that mean, first of all? Well, if you buy a stock at $10 a share and it gives you, let's say, a dividend of $1.20 annually or 10 cents a month, which is a very common dividend amount for the type of stuff I invest in, like GDV or EIT, SBC, etc., etc. And let's say, just as an example, let's suppose that the entire dividend, the entire $1.20 that year is ROC income. It means that your new book price is no longer $10, it's $8.80, right? So if you sell it, you will have more capital gains to pay if you sell it or when you sell it. So that's pretty much what it means when it lowers your cost base. So you're kind of deferring. That's why they say in the Harvest article, you're deferring your capital gain. Well, because you only have to pay it when you sell your security. So what if you basically never want to sell anything, right? If you're like me, if you just don't sell anything, so you're good with that. You don't really care about the ACB. Well, after 10, 15, 20, 30 years, is it possible that your book cost actually becomes zero? The answer is yes. If this is the case, any ROC income you get after that, for that particular fund, if it's zero, your book cost is zero, will be considered capital gains income. So it's only normal, right? So there's literally no more ROC that they could give you if your book cost is zero. So going forward, that income will be considered capital gains. So let's not forget that capital gains is actually the second best thing anyways. After ROC income in Canada, only half of it is taxed. The other half is taxed according to your marginal tax rate. So when it comes to taxes, guys, there is nothing better than ROC income if you think about it. It should be embraced, not feared. Capital gains is the second best. So how do you track all your ACBs and book costs throughout the years? This could be very complicated because you literally need to determine what portion of the income you're getting every year is ROC for every single freaking fund that you own, right? So there is a website called ACB Tracking that you could use to help you, but it's quite complicated because you need to input every single ROC value for each year and each fund. But fear not, guys, and don't worry. I'm happy to announce, if you didn't know this already, that tracking your own ACB or adjusted cost base is no longer required because most Canadian brokers now automatically track it for you. That's right, guys. I can confirm with 100% certainty and confidence that my broker TD, as well as CIBC and BMO here in Canada, automatically track your book cost and lower it automatically when you get any ROC income. How do I know this? Well, I actually figured it out by myself by accident by looking at my book cost on my broker page and comparing them to my book cost in my portfolio Excel tracker sheet. I started noticing discrepancies. I noticed that the book costs were lower in my broker than in my Excel sheet, right? So I was just staring at the screen for like 60 seconds and confused and in disbelief. I couldn't understand why. And then it just dawned on me, of course, ROC income. They're tracking it for me now and they're lowering my book cost automatically. Let me show you an example of what I'm talking about right now. So check out this example, guys. I'm in my non-registered cash account. And let me just show you two examples. So the first one I want to look at is Slate Office REIT. You see that I have 3380 shares here, and my book cost, this is the book cost, is $14,499. So this is the first one I noticed because as many of you already know, I have OCD and I would never get 14,449 14,499 worth. I would like an even 15,000. And when I go back to my portfolio tracker and I actually look at Slate Office REIT, my book cost here, same amount of shares, but book cost is 15,000 on the nose. So why is it different here? And same thing for Firm Capital REIT, the example I actually showed you guys. I have 2,130 shares, just like it says here. 2130, but here my book cost is 12,639, and here it says my book cost is 11,991. So this is what made me realize that BMO is actually tracking my return of capital because they're lowering the book costs accordingly here. So they're doing it with all funds. And I tried to do some research. I tried to confirm where it was, and I finally came upon this help article from Web Broker here. that discusses book value. And if you scroll all the way at the bottom, it explains what ROC income is, book costs, and all that, and all that. But where is it? Right here. So in April of each year, the book value for the ROC amount in accounts that track book value, blah, 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 is automatically updated, including both registered and non-registered amount. And it makes sense that it's in April because the actual T3 slips and the income amounts, they usually all come out in March. So that's when the full year is reported, right? So every April, TD will basically adjust your book cost accordingly. So I know for a fact that they also, CIBC does it, BMO does it, because I manage other some family accounts which use those accounts, so I could tell you for sure. In terms of other brokers like Questrade, Wealthsimple, I can't really confirm 100%, or Royal Bank, etc. But I have a strong suspicion that they also will be tracking the ROC income. So there you have it, guys. Just a quick word about bad ROC now. Like how can you tell, or how can you understand if a fund is giving you bad ROC? Well, essentially it's pretty hard to figure out if the ROC is good or bad. But in the third article that I showed you from Nuveen, if you go at the bottom, they'll basically tell you that in order to really try to evaluate if the ROC is bad, you got to look at the fund's net asset value and look at basically what it does over time. If it's just going down and down and down forever, most likely there's some bad ROC in there. So this is why it's important to always look at the fund's NAVs, right? The net asset value, the value of the fund, and see what it's been doing and see the average returns every year. So I hope this video was informative for you guys. I hope you now understand everything there is to know about ROC income. It's a very complicated subject, but read those 3 articles again if you still have questions, and I'm sure you'll realize what ROC income is. So as usual, guys, please hit that like button. I would really appreciate it. It's free for you and it helps the channel grow, so it's a win-win. If you like this type of content, please make sure you're subscribed. This channel is all about passive income investing, so make sure you're subscribed not to miss out on my future videos. Of course, visit our website, guys, passiveincomeinvesting.ca. That's where you could purchase my digital product, the Ultimate DIY Investing Package. I'm on version 3 right now. You just got to buy it once. It comes with a lifetime update. So when a package 4 comes out, you could simply log into my website, go in your downloads, and download package 4 for free, because it comes with lifetime updates. And what this package is basically a companion tool, a reference tool to help you build your own portfolio according to your needs. So it has sample portfolios for different types of investors, and it has Canadian sample portfolios and US sample portfolios. So it's great for everyone. Also on my website, right there on the homepage, I do offer a consultation service, a one-on-one consultation service with me personally via Zoom. So you could book an appointment there if you want to ask me a million questions. If you want some personal one-on-one help, you want to give me your situation, I could prescribe you a portfolio. I could help you build a new portfolio from scratch, transition to an income-focused portfolio. Whatever your needs are, I'll help you. I love doing these. I'm always sold out with the appointments, which is crazy, but I will do a Facebook post and a YouTube community post when the new updates, the new appointments are available. So on my website, always look at that message on top of the calendar to know if there's any slots available or not. So speaking of Facebook, if you want to be made aware of when appointments open up, make sure you join our Facebook group, over 6,000 members, Passive Income Investing. We're also on Instagram, so make sure you follow us there if you use that social media. As usual, guys, the mission of this channel is to help everyday, normal, working, regular people to invest on their own, DIY investing, doing it yourself, getting rid of those mutual fund fees so you could enhance your quality of life by building your own stream of passive income and eventually become financially free like us. There's no greater thing. And with that, see you next time.